Let's try to end on a positive note. I apologize for my throat, and that's why I have water here in case I need it to rescue myself. The topic of the keynote that we picked was something that we have been working on together as an ecosystem recently in these days and previously, and we will work more about rethinking the VC model for Africa. And I wanted to put a question mark on it and to challenge some of the things that we say to each other so that we don't have alibis and we don't have shortcuts with the view that there's enough good stuff going on, but we all have a duty to participate. So let me say I want to talk about two things. One is the thesis behind the need to adjust the VC model for Africa. And the other is instead something I want to dive in a little longer, which is to challenge that on 3 points. First is some of the features of the global VC model need to change. What we think are African problems are actually global VC problems. So we don't need to do anything special for Africa. We need to change the VC model for good in general. The second point is that some of the things that come up actually are already part of the repertoire of VC. So we have a duty, particularly the VCs, the GPs, to actually use the full range of tools that we have, and we don't always do that. The other is that regardless of adjusting the business model, we better deliver some performance here. And I think, and I will talk through it, that the thing to fix is not the entrepreneur, is the VCs, all right? And my overall message is we don't want to change things for Africa with the perspective that we have a problem child that needs special treatment, right? We want Africa VC as a performing innovator leading the way to global evolution of VC models. So we have to increase our voice to be one of the respected global voices of venture capital. So I think that's the mental attitude that I want to add. So the first point is, why are we so worried about the fact that Africa is different and we need to change? There's a few points. One, we say we need longer fund life because the time from investment to exit is more than the classic 10 years plus 2 years model. We think that somehow we need different fees and carried structures. We don't just need equity, but other instruments from venture debt to other stuff. We need more liquidity options because we have an exit challenge that is bigger than the global exit challenge. And there are alternative models that we need to look at from studios, corporate VCs, evergreen, ESO-linked solutions, retail investor, et cetera, because we want more founders to get access to capital. We want more VC funds to be raised and be sustainable. And we want to give the VC market, the Africa VC market, a fairer chance to mature and to perform. All right, that's the view behind the fact where we say we need to adjust the model for Africa, right? Okay, so let's start challenging this. First of all, longer fund life, different fees and carried incentive. This is a global problem, and I'll get into that. So the point here is not to say Africa needs a special treatment. The point here is to say Africa has a better ability to challenge these things that are eradicated in the global VC model because we have no legacy, because we can be the global VC sandbox because nobody cares about what happens in this environment, unfortunately. We celebrate that we move from 3 billion to 4 billion. It's from 0 to 0, right? We should be 20, 30, 40, 50 billion a year investment, not 3 to 5. And so the point here is that we can leverage that nimble situation that we have to fundamentally be more innovative, more outspoken, and have a seat at the global table of venture capital, rather than saying, please treat us differently because, we are a little bit handicapped. So that is my first point, and I want to share some data with you. When you look at global unicorn, the average year is 9 years, and when you look at the full spectrum, it's even longer. And when you look at the best Africa exit, it took us a long time, but not longer than the best global VC-backed companies. So the first point is fund life, extending fund life is a great idea, but for everyone, not just for Africa. So we should say Africa, just like everyone else, would like to underline the fact that it would be better to have longer fund lives, right? And this is the same point. If you look at the best global VC funds, in order to liquidate them completely, you need 14, 15, all the way to 20 years. So this is great to think that we need longer funds, but we shouldn't say, please, treat us differently because it's an African problem, right? Second point, incentives, fees, etc. So as you know, the VC funds have this terrible structure where when we sell companies, first we return the capital, then we give a preferred return, and then we get into the carried interest. And this is a problem that is being rediscussed across many asset classes, from real estate, infrastructure, private equity, VCs. And for the VC, it's a global issue. It's not an African issue. So when we say we should adjust the fee structure, great. We should adjust the fee structure because we, that are as good as everyone else on the freaking planet, also would like to support this change, right? The second point that we should think slightly different is when we say we should go beyond equity. Sure, this is not a great innovation. It's been around for a long time, and it's been around a long time in Africa as well. So the point is, can we get access to those available resources for venture debt, and can we use them in a way where it's a good idea and we generate returns so we get more of that? So these are data from two places. One is, thank God for the big deal, and Maxime and his colleagues at Africa, the big deal, that give us always constantly a lot of good data to think about ourselves and to improve ourselves. But also AVCA, the African Venture Capital Association. When you look at the actual numbers, the availability of venture debt has grown very significantly here now. So when we say, hey, we shouldn't just do equity, we're doing already venture debt. So this is more of a point to say there's many tools in the toolkit of venture capital. Let's make sure that we use all of them. But some of them are here now and available to use. The last point is to say we should have a very special vehicle, finance structure, etc. Yes, but we should deliver returns. And the interesting thing is that there are a lot of great performing companies in Africa that are performing very well with the current model. So is it the model, or is it the quality of the entrepreneurs and the VCs? Yes, of course, the model will help if we adjust it somehow, but the quality of the entrepreneur is as good or as bad as anywhere else. And so my point here is that in order to move from great companies to great investment, in other words, to be able to find the great entrepreneurs, to support them and to exit them, we need to have venture capitalists that can do a better job of supporting the journey. And the job of the entrepreneur is to create a great company. The job of investing and exiting is more on us, right? So that is something that I want to talk about. So when you look at the features of the global VC successes, right? What you see when you compare the unicorns to the non-unicorns, unicorns tend to raise more capital. The unicorns tend to have actually slightly higher valuations. And the probability of finding a unicorn goes up when you invest in later and later stage. In other words, the company that managed to raise more capital are great companies that deserve more capital, right? It's not the other way around. But they do deserve a lot of capital. So there are something that always happens when you are in the journey of creating a unicorn, right? Let's look at the African companies, and let's use, once again, Maxine and his colleagues at the Africa Big Deal. One of the many analyses that they've done is to say, let's look at the 100 companies in Africa that have raised the most capital, right? As a proxy of the companies that deserve more capital. And so the company that were performing in a way where we see us say, I like that, I would like to put more money into it because I'm expecting a great return. There are three features. One is the money is needed. To create an outlier, you need to use a lot of money. The second point is that the companies tend to operate in high margin, fast growth business model. It's fintech, it's energy, it's mobility. Those are the highest concentration of the companies that attract more capital. And most of them, 80% of them, are actually based in the most supportive ecosystems that we have in the continent, which is Cairo, Lagos, Nairobi, and this place where we are today. So it's the same features of the global unicorns, right? More evidence of Africa, if you go back in time and you look at either the unicorns, either the Africa exits above 100 million, if you look at the companies that have raised more than 100 million, is a lot of money, growth and high margins, supportive ecosystem, right? This is the current model. So no retail, CSO, nothing of that, right? Revenue-based, no. Current model, great companies, great VCs, and you go through the journey. Now, the other point is that it's fine when companies fail. In our business, we are in the business of investing in companies that do not work, right? The return of our funds are driven by a subset of the companies that return a lot of money. That's for the funds that actually work well. So it is perfectly fine to lose half of the fund. It's not how many companies you lose, it's about the magnitude of the winners, right? And so the point that I'm raising here is it entrepreneur failure or VC failure? And I tend to believe it's VC failure when too many don't work. So there's been a lot of work here done by researchers that have looked at the features of the 2,000 unicorns that we have created globally so far, and the ones that didn't work, right? Of all the investments in venture capital, some worked, some didn't. The largest, the most relevant driver of failure is the team. Now, is it the company problem or is it the VC problem? Because we are the people who pick the teams, right? They don't pick themselves. So what I'm arguing here is that there is a lot of responsibility in us as VCs to find the right company and to fund the right company. How do we select them? Are we selecting because of FOMO, because this now I need to have a couple of crypto companies in my universe? I'm reading a lot about AI. My cousin in Palo Alto is investing in this. I need to do the same. So on which basis do we select? Are we investing in the business model or in the people? Are we looking at things that if everything works can be really big, or in things that seem to make sense? So we look at maybe 100, 120 companies per month. We invest in 4 every year, and we still make mistakes. On a global basis, the ratio of total companies on the planet that look for VC and company that gets funded is 1 for every 180. It's 178. So it means that you look at 200 companies before you pick one. Do we do that? Or do we compromise? I've seen 10 companies in the cross-border payment space, and I'm picking one. But that's almost certainly will not work, because it takes more than that to actually find the winner, right? So my point is that we know that the main driver of the success or the failure of the company is the quality of the team, of the founder, their ability to attract a great team, to attract capital, etc. But when it doesn't work, I would not blame the company. I tend to blame the VC that picked the wrong team and that didn't assess them properly, right? We ran an exercise internally to say, okay, we've invested right now almost 150 million in Africa. What have we learned from the first 100 million? And what we've learned by looking at fundamentally companies that have worked and companies that have not worked is the fact that some of the winners, all of the winners, have some features, and the losers have other features. And the features are, 1, fantastic teams. more than the business model. The companies pivot anyway, so you can spend all of your life assessing the industry attractiveness, etc., and then the founder will play in a different space. So the ability of the founder, the repeat founders, the notion that they know how to attract a team, how to attract capital, is really fundamentally the driver of the good company, the best predictor. The second is, how do we manage portfolios? Construction. It's a little technical, but it's an important point. VCs tend to write checks initially, and then they decide whether or not to continue to support the company over time. Those initial checks need to be reasonably small, and when the companies don't perform, it's okay to unplug. We celebrate bad companies that get unplugged with the same party where we celebrate great company that exit at high multiples that get more capital. Because the ecosystem is better with a failed company, with a bad company that doesn't work and gets killed. And the entrepreneur, we're happy to see him or her and to say, let's do something different. And that entrepreneur is better than many of the other entrepreneurs that have not failed. So failures are great news in a VC environment, in a VC ecosystem, right? And so my point is, what we've learned for the first 100 million is that what counts is the team. The way that we deploy money as VCs is very important in terms of the size of the tickets and in terms of our ability to decide follow on, yes, no. And the other point is that for the Africa ecosystem where it is now, 2025 and the next 5 years, we do not have the luxury of picking countries, stages, or sectors. We have to be able to play with any form of life that can be successful. So when we say, are you generic Africa VC funds or are you specialized? It's a really silly question. When you talk to global investors and you say, I run an Africa VC fund, they say, oh boy, you are very specialized. You only do Africa VC, right? So that's it. The Africa VC is African entrepreneur. There must be something African in something that works, that can grow fast, that can become profitable in the future, not now. That's another point, the cancer of having PE people entering VC companies. And they ask, we should be profitable tomorrow morning. Great. So we have an irrelevant company that is profitable. I can tell my mom I have a profitable company, and it does nothing. The high margin is important, but EBITDA is for later. We need to absorb a lot of cash to grow fast and become relevant and become a cash-generating business, right? So that is some of the lessons. And if you're disciplined in applying the lesson of only picking great founders, of giving them the right amount of money and following on or unplugging and killing them with love, that is very important. And if you don't say, oh, I only do fintech, why do you only do fintech? I only do South Africa. Why do you only do South Africa? We should have capital available for every form of entrepreneurship that uses technology to make the continent a better place. Better place meaning not that we are good-hearted, it's that we want to make money. And in order for that to happen, we need to pick markets that are underserved, right? And technology can reduce the cost of serving those markets. So all of a sudden, they become profitable. So it's not magic, it's not philanthropy, it's economics, right? The other point is exits, liquidity. Yes, it's challenging, but these are numbers globally. It's tough to exit companies globally. We think it's only Africa. We think that in Silicon Valley, they exit great company every day. That's not the case. It's mostly M&A, but IPOs are possible. And it's slowed down for a few years, or the exit multiples have gone down for a few years, right? So when we think of Africa and the liquidity opportunity, there are some exchanges that are becoming relevant. I think Joburg is one of them. Others are making an effort. But if you look, for instance, at London Stock Exchange is proactively looking for Africa tech companies to list. Are the VCs of Africa aware of that? Are we all talking to London Stock Exchange to bring them here and show them companies? Where are the intermediaries? Where are the small Morgan Stanleys and Goldman Sachs that can run an M&A exit process, right? So there are challenges. There are these terrible cap tables where you have an impact investor, a VC, a PE, and the entrepreneur is in the middle. One says we have to serve 1,000 goats. The other guy says you need to be profitable tomorrow morning. We say you need to grow as fast as possible. And the guy's in the middle. We as VC have a lot of responsibility of helping the entrepreneur move from having created a great company and making it a great investment. You may say correctly, this only happens to a subset of the portfolio. Exactly. Most of the companies will fail. That's the job. It's not we're in Africa, most of the companies fail. No, we're in Palo Alto, in Silicon Valley, and most of the companies fail. It's the name of the game. So when we wake up in the morning, we know that we will spend the day looking for companies that will fail. Occasionally, we will find companies that don't fail, but every time we make an investment decision, we need to believe that if everything works, and very rarely everything works, that company can return the fund entirely, meaning we're looking for companies that if everything works, can give us back 70 or 80 million, just that company. And you say, oh, but in Africa, only a few companies per year exit at 500 million. Exactly, only a few companies. And we only need one of those per year. Are we trying to do that? Or are we trying to support entrepreneurs in their journey regardless of the upside? Right? So another point, and it's the last point that I have here, is what can we do to attract more capital? It's very easy, show better returns. Right? This is an analysis of JP Morgan that they do on alternative assets. So they look at commodities, infrastructure, private equity, real estate, venture capital, etc., and they count the returns of each of these asset classes in every year and over a long period of time. Venture capital is the best performing globally, and so the reason why we see a lot of money going into venture capital is not because everyone has gone crazy on AI, it's because it's the place where they've made more money in the last 10 years. So the first point of saying, what can we do as an ecosystem to attract more capital? Should we travel to Palo Alto, show the companies? Let's create great companies and sell them at high multiples. The reason to call global investors and say, kindly put more money into VC Africa, is not to say because Africa needs is the cradle of the future, the demographic, because you will make the same money at least that you are making in Asia, in Europe, etc. Right? The other point is to say, sorry, there's one slide here that is not here, that anyway, I'll just talk to about it, is local investors. How do we have more local investors? And very often people talk about India. And India fundamentally is a place where more than 50% of the money behind venture capital is local. Why? Because of returns, because of the expected return. So the reason why a lot of family offices and corporate in India have put money into Indian venture capital is because they could see not the actual returns, but the upside. Are we communicating properly the upside of Africa venture capital? Or are we saying, give me a longer fund life because in Africa we're more handicapped, right? So, so the point that I want to make here is that if we use this different narrative of saying, yes, we do need different models as part of the global change of venture capital. And yes, we want to use the full range of tools like everyone else. And yes, we want to deliver world-class performance regardless of a model being what it is or the evolved model, is that we don't need more founders to get access to capital. We need great founders to get money, not all of them, not more, because if we have more companies that get venture capital money, it's better. No, if they're not good entrepreneurs, it's not better, it's worse, right? We need more VC funds. No, we need the VC funds that have an ability to find the right entrepreneurs, to select them, to assess them, and to support them. Those VCs need more money, not any form of VC. And my assumption is that most of the African VCs are good at that. And so, yes, the Africa VC market is given a fairer chance to mature and perform, but the point is that we need to be, in the eyes of global capital, an asset class that is as good as the rest of the options, not one that is modified because it had problems, right? So my point is, once again, it's great to have a better VC model, but also we need to have better VCs. Not better entrepreneurs. The entrepreneurs are fine. I think that the evolution of the model is a good idea, but also more discipline. More discipline means more risk-taking, not more conservatism. Discipline means sticking to the rules of being open to innovation, but with great founders and enough capital to support them to go for the upside. So that's the point. Let's try to use a different narrative, not to find an excuse to be treated differently because we have problems. No, because we are part of the global VC asset class, and we can be part of the best performing part of it. Thank you.
Maurizio, thank you very, very much. Really insightful. Thank you. I don't know. Do you maybe want to take a question or two?
Yeah, sure.
Let's do that. Are there any questions for Maurizio? You know, it's very seldom you answer everybody's question. You know, one guy.
Okay.
Let me bring the mic to you. Hold on.
So thank you for the presentation. So what is a great founder, and how do you recognize a great founder?
First of all, we make mistakes, so we try to recognize the best founders. A great founder is a founder that has a few features. One is an ability to attract great talent and great capital, which are the two main ingredients of the black box. The other is somebody that doesn't say, my advantage is the partnership with Visa, but can articulate why his proposition is winning in the market and how to execute it. What I mean by that is that there's usually a group of people or companies with a problem. I think I can solve that problem, and there are other people that are called competitors who are trying to do the same. Why do I think as a founder that I'm better equipped to win that? And there's only two possibilities. I have a lower cost position, so I can charge less, and or I project, reality doesn't count, but the client, the target client, perceives that I'm giving them more, so I can charge more. So customer value perceived and pricing. And those are the great founders. Repeat founders tend to be more frequently good because they have made mistakes and they tend to have learned that lesson. Yeah.